Hello and welcome to Multnomah Group's review of the capital markets for the fourth quarter of 2020. My name is David Williams and I'm a senior consultant at the firm. 2020 was a challenging year. The year presented significant and unpredicted obstacles both here in the US and abroad. The pandemic's impact to economic activity was felt in very volatile fashion as we slowed the economy to slow the spread in Q1 and in Q2, and then as the economy started to come back to life in Q3 and Q4. Q1, we saw the economic activity in the US decline by 5%, followed by a 31% decline on an annualized basis in Q2, within a sharp rebound in Q3. And it's estimated that Q4 here in the United States will be positive, roughly in the 3 to 5% range. Ultimately, the US economy looks to be contracting for the year 2020, somewhere around 2% potentially. We'll get more information on that as we wrap up the month of January. Unemployment ended at 6.7% for the year. That's significantly up from the end of the year 2019, where the reported number was approximately 3.6%. Again, as with the trajectory of the pandemic, unemployment spiked early part of spring, hitting just under 15% in April, and then declining as the year went along. We saw approximately 22 million jobs lost during the February through April time period. And then as we move through the end of the year, about 12.3 million of those jobs were recovered. That still leaves us with about just under 10 million jobs less than at the beginning of the year. We saw significant impact significant stimulus from both the federal government here in the US and abroad. In the US, we saw approximately 4.2 trillion in fiscal stimulus, most of that coming through the CARES Act, but then also as we went into the year end, the omnibus spending package, there was another 900 billion or so in spending. But the Fed was also very active, injecting liquidity into the system to the tune of about $6.2 trillion. All told, that 10.4 trillion in stimulus, both from the on a fiscal side as well as from the Fed, accounts for about 50% of US economic activity. Globally, that figure is estimated to be about 28 trillion, or almost a third of global output. So we had significant impact of stimulus both here and in the US, a learning, I think, from the financial crisis of 2008, 2009. There was a reaction that was quick and it was large. As we transition from the economic environment and start to review the investment, the capital or the investment markets, let's start with US equities. US equities were positive both for the quarter and for the year. The S&P 500 was up 12.2% for the fourth quarter and 18.4% for 2020, although it was volatile. 2020 actually saw one of the largest drawdowns and comebacks in S&P 500 history. What that means is that from the high to the low, or sometimes referred to as the peak to the trough, within the year, the S&P 500 was down 34% from its highs in February, pre-pandemic highs in February to the trough there in March. We saw about a 34% decline, but ultimately there was the really, really strong comeback, and we saw the year up we saw the stock market up for the year about 18%. Stocks ended the year From a fundamental standpoint, sometimes referred to as price to earnings ratio is a common measure where we take the price and divide it by the forward expectation of earnings. Stocks look expensive. They're at 22.3 times. That ratio is 22.3 times versus a historic average of about 16.2. So relative to stocks over their long-term history, stocks look a little expensive. As we look up at the upper left-hand corner and start to focus maybe on the fourth quarter, we can see a bit of a rotation in investor sentiment as energy, noted by the green bar, financials noted by the light blue bar, and industrials noted by the brown bar were the strongest performing sectors of the equity market during the fourth quarter. As you look to the right and see sector performance for the year, 1 year, and 3 years, you'll notice that the technology sector and consumer discretionary sector tend to lead the way for those time periods. As we go towards the bottom of the page, we show equity market performance by style. So we break it out by value, blend growth across the horizontal, and then large, mid, and small, the capitalization going from top to bottom on the vertical. What you'll notice is that value outperformed growth for the quarter by a decent margin, and small outperformed large. So you do definitely see a rally. Some have referred to this as a little bit of a low quality rally here in the quarter. But if we look at longer term, this one quarter does not overcome what has been a long-term trend of growth outperforming value and large outperforming small. If we look at, for the 1 year period, growth outperformed value by almost 40%, a little under 38% for the large cap segment. And that holds true across the different mid and small cap segments. Long term, looking at the last 5 years, growth has significantly outperformed value stocks. Flipping to fixed income on the next page, the Barclays Aggregate Bond Index, a broad measure of fixed income performance, was up 0.7% for the quarter and 7.5% for the full year. Interest rates fell over the year, which supported price appreciation. The yield curve really declined across the curve, across all maturities, ending with short-term interest rates at 0 and 10-year notes right around 1%. For the quarter, we saw that similar to equities, investors sought riskier assets, so high yield outperformed investment grade securities. So as investors were willing to, or bonds were considered to have a lower likelihood of, or higher likelihood of default, investors were rewarded with higher levels of return. Also for the quarter, we saw that short-term outperformed long-term, but for the year, the reverse is true as longer-term bonds outperformed short-term. Jump ahead a couple of slides and we'll talk a little bit about international equities. For the quarter and the year, both international equities, for both periods, equities were positive, although not as strong as in the US. For the quarter, the the All Country World ex-US, which is a proxy for non-US stocks, was up 17.1% and 11.1% for the full year. We saw that emerging markets outperformed developed markets in 2020, and that again, US equities outperformed non-US equities for the year. Similarly, looking at it from a valuation perspective, developed markets look a little expensive relative to their historic averages at a 21.1 times price to earnings ratio relative to their long-term average of 16.2. So what that means is that typically you may see that some market commentators will say that some of the future returns were pulled into the current year, and that helps explain some of the higher valuations of equities relative to their historic norms. So we move to the slide titled Unpredictability of Asset Class Returns. We'll end the discussion here with a brief review of asset class performance. Ultimately, 2020, what this chart is showing is that is the major asset class returns on an annual basis that are offered in defined contribution plans. Ultimately, 2020 and 2019 look similar. So if we look at these columns on the right, you see that risk assets, stocks, US large cap stocks, US small cap stocks, developed and emerging international stocks tend to be at the top. So the highest performing for both periods. Equities outperform bonds, and US equities outperform non-US. Given the unpredictability of returns and the economy as a whole, I think that this slide illustrates the benefits of a diversified portfolio. And ultimately, we don't know what the future holds, but we know that diversification provides some insulation from market extreme swings. I'd like to conclude this discussion with an offer. If you have any questions, to please feel free to contact your Multnomah Group consultant, and thank you for listening today.